on Closing Bell, and our next guest is Rajesh Bhatia, CIO of ITI AMC. Rajesh, great to have you on the show. Thank you very much for joining in. Let me ask with a simple, basic question. Is the worst over for this market?
Well, I wish so, but I think not. I think I'm feeling a lot better though, given how the markets have corrected, especially the mid cap and small cap. The last time we spoke, I said curb your enthusiasm in the markets. And of course, I think the reset that has taken place, particularly in the mid cap and small cap, is making me feel a lot better as far as company valuations are concerned. At least there is some sanity, if not all sanity. It's also healthy that I think, the expectations of investors have just gone through the roof as to what they should be getting from Indian equities. I think that is also kind of moderating, and there is greater sanity in terms of expectations. So all of that, what is happening is very healthy. Having said that, I think the challenge for India is that while the large cap has become reasonably priced, the mid cap and small cap is still at an elevated level. You can have that elevated level if you have greater visibility of growth. There is unfortunately a slowdown that is taking place in India. You can see that with power consumption, which is only up 3 or 4% a year. We were talking to an industrial company, and they were saying that the demand for motors has come off, which is reflective of industrial demand in the last 3 quarters. So a lot, passenger vehicle data, which is again suggesting, very anemic growth. So there is a slowdown in the economy that is happening. And unfortunately, the global picture is also very uncertain. With the tariffs, etc., we don't know whether is it going to cause a recession or is it going to cause inflation. So again, that is a very uncertain environment, that we have just walked into. Given that context, I would want probably better margin of safety as far as mid cap and small caps are concerned. But in all, I think it's healthy that the markets are correcting, and it's at least giving us greater sanity as far as valuations are concerned.
Rajesh, hi, good afternoon. Which means, would you, if someone created cash, should they buy select mid caps and small caps?
Yeah, I would say that, there are some pockets, I wouldn't say a lot, but some pockets which are emerging, which is reasonably priced. Again, I'm not saying that they're extremely compelling, but from a medium term perspective, look, the Indian macros are not damaged. I mean, we have still a very responsible fiscal deficit. We have still a very responsible Reserve Bank of India, which has...
But what kind of sectors, Rajesh? What kind of sectors?
So I would say, power transmission, etc., still are, a good places to go to. Of course, I would say in the mid caps, of course, large cap banks are very attractive, which everybody would tell you. Life insurance is attractive, telecom is attractive. All of that is in the large cap. But even in mid cap, my sense is there are places like private banks in the mid caps which are looking attractive. So there are pockets that you can find within that space which are now reasonably priced.
With full disclosure, Rajesh, you want to share a few things you've done? Your team at ITI has done over the last
my compliance would kill me. Prashant, my compliance would kill me if I took any names.
You can blame me for it.
So no, but I think to be fair, that we are finding some value, and we are kind of putting money to kind of work, and which is encouraging, right? But yet, I mean, from a bigger picture, I do remain concerned that this doesn't seem like, even if there's a bounce, this doesn't seem like a V-shaped bounce, because there's just so much uncertainty on the domestic as well as the global front. At best, even if the turnaround comes, it will be probably a U-shaped kind of recovery.
The other thing, Rajesh, which I think Gurmeet was also, by the way, Gurmeet also said power and power transmission earlier, but he also was talking about the US 10-year. So how much of an impact do you think this will have? Gurmeet was talking about through the lens of the 10-year, and it should come off because it's essentially you got to add some currency risk, some risk premium, etc. So the return hurdle becomes larger for foreigners. He was talking about that, but add to that this tariff bit. Do you think it'll hurt, or it'll keep flows away? In what sense, to your mind, Rajesh?
Okay, let's look at the positives, right? The positive is that in spite of all the talk that, Trump has been making. It seems like he wants to front load everything. He wants to get all the action items you want to kind of get it done in the next 3-4 months. So he's kind of front loading every single thing, whether it's geopolitical or economics, right? But in spite of that, the dollar hasn't moved significantly. The 10-year yield has actually been quite benign, because it should have meant even more volatility as you move forward, given the kind of design that he has. But it's been remarkably stable, because if you put tariffs all across, reciprocal tariffs, somebody has to bet on inflation. Somebody has to bet on global slowdown. I think there is already talk that if you have this kind of uncertainty, capital expenditure from the private sector is going to slow down. Consumption is going to slow down globally. And who's the global champion who's going to lead the global economy if US also starts to suffer? So see, on the positive side, despite that narrative, these economic variables are stable. On the negative side, there's very little scope for the Fed to reduce interest rates. So interest rates in America are going to really, remain kind of strong. And the dollar, therefore, will continue to be strong, because, in case the world is looking at a uncertain future, people are going to migrate to the dollar. Which brings to Gurmeet's point that, if you're an FI, the interest rate, the risk-free interest rates in America are very, very attractive. You come to India, there's a hurdle rate in terms of covering your currency cost, which is about 2.5% at this moment. And then you're expecting a return from India. But by the way, you are negative on emerging markets. So there's very little reason for FIs to kind of come to India, and the incessant selling that we are seeing from FIs probably could continue. So that's the negative aspect as far as we are concerned.
Okay, just hold that thought, Rajesh. Since you mentioned power and power transmission, we want to sort of come back, and I want to drill a little deeper into that theme. Give us a second, because our colleague Vivek has been looking at a couple of interesting brokerage notes that have come in on stocks like NHPC and Tata Power, and both these stocks are actually up as well today. Vivek, tell us, I think one is CLSA, which is the other brokerage, and what are they saying on these stocks?
Well, that's right. So NHPC, interesting report coming in from CLSA that we highlighted in the morning. What they've done is they've upgraded the stock from what was earlier an outperform rating to now what is essentially a high conviction outperform rating. Although they've trimmed the target price by 3 rupees to go ahead and account for a higher capex and on the back of cost overruns. What they're saying is that the recent 25% stock correction gives investors an opportunity to go ahead and accumulate an inexpensive utility at 12 times FY27 price to earnings. What are the key catalysts according to CLSA? First up is the start of the Parbati 2 hydro project, which is expected in March 2025. Company's entry into shorter duration regulated pump storage, and also the rise in ROEs that is expected after the CRC ruling, and slew of new project awards to NHPC, according to CLSA, are re-rating candidates. Remember, NHPC currently has 15% of India's total hydro capacity, but 67% of the total under construction hydro capacity. So thereby, any change, improvement as far as India's hydropower generation is concerned, NHPC stands to benefit significantly. The other stock on the radar is HSBC. HSBC upgraded Tata Power today, mainly on the back of now compelling valuations. They believe that the recent stock price fall was largely on account of factors that were beyond the company's control. Some of the weakness reasons that HSBC have indicated are: number one, power demand weakness. Along with that, power purchase signing agreements have been delayed significantly. Also, privatization of discoms, something that the street was anticipating, has also been quite slow to pick up, especially in states like Uttar Pradesh and Rajasthan, where the company has interest. Overall, on the back of the steep price correction, and also HSBC likes the company's entry into cell as well as module manufacturing. They're seeing margins over 17%, and on the back of that, they're positive as far as Tata Power is concerned.
Okay. All right. Got it, Vivek. Thanks very much for that. So, Rajesh, just to quickly go back to this before we let you go, you said power and power transmission. When you say power, do you mean traditional large generators like, Tata Power, or are you talking about more about the renewable opportunities that are out there in the market now with several companies like Wari getting listed? Again, if you could be a little more specific, is it the overall space one can buy, or, what exactly do you look for here?
So there is an energy. The big picture is that there is going to be an energy transition, right? And the renewables have to will be the growth sector, because that still has to be added at a much, much faster pace. And anything that supports that activity is, I don't have so much a view on the equipment suppliers, but definitely the guys who are in the IPP business or the transmission and distribution equipment or, facilitating that activity is concerned, all of that look far more visible in terms of growth opportunity as you move forward. Surabhi, if you'll allow me, there's just one more thing I would want to talk about, which you guys asked about the global macro. Look, the U.S. has Scott Bessent as the Treasury Secretary. He was a hedge fund manager earlier, right? So he understands a lot about global macro stability. He has already pointed out, I want the 10-year Treasury not to go, in either direction in any significant way. Right? He wants to basically make sure that that's stable and under control. Now, if you have that, which means a lot of this rhetoric of Trump, I would like to bet, is going to die down sooner or later because he can't move to extreme decisions because that will definitely impact financial stability of even United States, if not other countries. So my sense is that given that people like Scott Bessent exist in that system means that I think the scope for doing wild things is certainly reduced.
Well, Mr. Trump is only saying, I'm not doing anything wild, I'm just reciprocating. It's reciprocal tariffs, right? And he's saying it's only fair. He's given us an idea of what he wants to do. So we'll see if he sticks to that. But, the thing is, we don't know exactly. And I think we'll play out some sound bites. We had people like Samiran Chakrabarti of Citi, Chetan Iyer of Morgan Stanley, who've looked at some of this stuff in detail in terms of implications for an economy like India. But that's a little later. Rajesh, thank you very much for joining us. Good to speak with you. We'll take a quick commercial break here. We're going to come back.